Okay, so let's get right into it. The This week, I want to start with the economic data, and because it really kind of punctuated the entire week. Although I was a little surprised that Monday and Tuesday, before the CPI came out, that the market really shot up, and so I was kind of expecting kind of two calm days in the markets, but by the time we got to Wednesday, a lot of the fireworks had already happened. Um, the CPI and PPI data came out really well, and so let's start with the economic data, and I'll kind of be a little bit all over the place on different pages here as I go through it, just to kind of show uh, the effects of things. Um, let's start with the economic calendar. And when we had Monday, we had a bunch of speeches and, the threats of the Fed per usual. Tuesday, not really any data. It really all happened on Wednesday. I'd anticipated, based off of what had happened with the 10-year Treasury, that mortgage rates would go up for the week unless something would happen on Monday and Tuesday, which it did not. But when the inflation rate, the CPI, came out lower, we saw a reaction from the markets almost immediately. And if we go to, here's Monday this week, Tuesday, these are daily data, obviously. Wednesday, we really shot up, and then it kind of backed off a little bit in the afternoon, and then we've just kind of been putzing along uh, the entire day today and kind of backed off. The Dow Jones wound up positive for the day and the week. And you can kind of see that with the SPY. For the week, it was up. It was a nice bullish engulfing candle there. And we look at the daily data. It's the same thing. It was, like I said, I thought Monday and Tuesday be quiet, but with that pre Wednesday report on CPI data, you can see we gapped up. Let me see if I can make these a little bit bigger. We gapped up on Wednesday with the CPI data, and then Thursday was fairly strong. Today wasn't bad. I mean, you expected some type of people were worn out. The thing that's kind of concerning me is I don't really see the volume yet. You don't see the big volumes that you might expect to see with the markets going up like this, and we'll talk about that a little bit later. The Qs, same thing. We gap up twice on Wednesday and Thursday because we got the PPI data on Thursday, going back to the economic calendar on Thursday morning, and it came out better than the 0.2%. Not much, but it's enough to, people get feeling pretty positive about it. The only other thing this week was on Friday, the Michigan consumer sentiment came out much stronger today than I think anybody had expected that it would. So from a market perspective, it's kind of what I've been expecting from the data and David Hunter's forecast. I think others are still kind of in shock that the markets are going up. But like I said, I did research on David Hunter before I started following him, and he's early. He's definitely somebody who's not an agreeable person. I wouldn't call him that. He'll argue almost anything, but and he certainly has his domain he doesn't like crossed into. But on this same, that doesn't bother me because he's got a unique perspective, and it seems to be playing out. So we'll end with that, with the conversation about his calls. As far as the rest of the market data, we had the IWM, which is the Russell, and again, on Monday we had a nice candle when I thought things would be real calm until we got the CPI and PPI data on Wednesday and Thursday. But we had the big gap up on Wednesday. We had a kind of a downer day today, although it made a little bit of a comeback this morning. And these are just areas marked here as support and resistance that I had on these charts. But we did break out of this kind of channel here, this pennant, and seem to be holding it there. If we can hold this around, I don't know, 191-ish area, look for a run back through this next resistance level and then all the way up to, 200. But, you can't be unhappy with the way things are happening with the market. And, there's a strong sense of bull trend, at least from my perspective. But we'll look at some things, like I said, a little bit later, and looking back at David Hunter's forecast. What other things happened? Well, the other thing that happened when we got the CPI and PPI data is, boy, did the 10-year yield really, we went up and filled these gaps here. And here at a little over 4%, and then also this one that we expected to fill at roughly 3.9% on the way up, and then we came back down. We got a little gap here, but in general, we've got the 10-year rolling over a bit here, and so you can probably, I would say you can expect, unless we get a real change. We started to get a little bit of a bounce here today on the yield, but it was just down to 3.75%. So we'll keep an eye on it. It might come back up here. I'm guessing this area right here was acting as resistance, and it's my expectation is that this thing will continue to kind of work its way back down. I don't have the support areas on here for these data. But we went and we filled all these things, and now we've started to make the U-turn, which again, what David Hunter had been calling for in his forecast. Then we have the dollar, which again went down, broke a few levels here very quickly, which kind of surprised me, which my expectation here is on the dollar get a little bit of a bounce. But as you see the dollar go down, you're going to see more expensive items that are imported, because a strong dollar keeps the prices down. Crude oil for the week, it kind of has been making its way up, but today we had it back off a little bit, and keep track of that. But I think as the economy weakens, we should start to see crude oil continue to make its way down. But it broke out of this pennant here and made its way up, out of it, and hopefully we'll see it turn back down. The VIX, volatility actually was down for the day, just a little bit. It was just kind of a blah day. The SPY was up most of the time, and then it backed off, and then the Qs have been down pretty much the whole day, and so was the Russell, the IWM, up here for today. So it kind of ended the week. You kind of expected it was a little tired. And then, but the good news is the breadth has increased, this week. Here's the 5 days. We gapped up Monday, on Monday, and then Tuesday. We don't have the data, I guess, for Wednesday and Thursday. It must come out later, on Friday. But, we've got 58.2 breadth in the market of the percentage of stocks that are over their 200-day average, which is always a positive sign. And expectation we need to get, especially for the IWM, the Russell, if it's to continue to increase, we need to see this breadth continue to expand, and also to hold up the rest of the market. Things move from one area to another from time to time. Technology is really dominated pretty much for the entire week. So that's a look at that. Let's take a look at the economic data for next week. Told you I'd be jumping around a little bit. We see the manufacturing index. It's going to be pretty quiet for the most part. At least my expectation is that it will be. Retail sales, we'll get that. we'll get the new mortgage rate that should go down probably 7.8% or excuse me 6.8% or so. Building permits, a lot of housing data next week, but it doesn't seem to really be moving the markets much. But I think as rates go down, some of these should be favorable. So we're in this time period right now where the data are favorable to the economy. But my expectation is this won't last a whole, we may be in this blissful period for maybe another 6 months, 7 months. And we'll talk more about that with the David Hunter forecasts and look at things there. What else do we have? The Philadelphia Manufacturing Index, of course, the initial jobless claims. So all the usual data, and then we'll start to get more data as the month moves on, especially not this coming week, but the following week. We'll get the PCE data and see if the downtrend is continuing. Investor sentiment, a little less bullish and a little more bearish, just slightly. A lot less bullish, 5% or so. Fear and greed index still in the 80. Even after today, I think everybody's expectation was the market would kind of take a breather. And then I want to talk about this, and I think it's a good segue, because when we're talking about these data here with the fear and greed index and the investor sentiment, it's not really accurately telling what's going on. And so I put up here the SPY, which is pretty heavily traded. And if you look at the amount of calls versus the amount of puts, other than this spike here on the calls, you've got still a ton more puts in the market. And this is for today. And then we start to get into, let's just take a look at the weekly here. You see lots of puts still by volume, 167,000, whereas, the highest here, 76,000. So there's still a lot of bearishness. I think this may more accurately share what's going on. If we're at 449 now, and the maximum pain price where the brokers basically brokerages make their money is what's the maximum pain price. If we start getting out here, these all get squeezed. These puts get squeezed, and that shoots the market higher because all these positions have to be closed. And so I just kind of started looking through this just to see, and pretty much you look at August, the primary 18th, which is the kind of the primary monthly option expiration date, and then you still got a ton of puts. And then so put your money where your mouth is, I guess. Would indicate that most of the money's still on the bearish side, and nobody's really moving here. These get squeezed in September. So there's a lot of puts still out there, and my expectation is that they could very easily get squeezed. Now I want to talk about David Hunter. I know I talk about it every week, and I'll talk about it more, especially as his forecast seems to be coming true. Let's go back and look at some of these data. One other thing I want to look at that goes along with it, his expectation, his forecast is, okay, we get this big run up in the markets, and then we're going to get this collapse. Well, let's take a look at the run up first. We had this in the Dow Jones. We're basically coming out of this head and shoulder pattern. We need to break up this way. That should run us up, could be at least another 3,000 before we get another correction. I think I've got it marked up in here as potentially a spot that we would run into some resistance. But his forecast, it was originally 45,000 on the Dow Jones Industrial Average, and which was here. I marked it on here, but now he's moved it to 48,000. So, which just go ahead and move it up there in that general vicinity. And, in 48,000, now we're talking, still got a lot of room to run in accordance with this forecast. But the first thing you have to do is clear this 36,958 mark, which is basically 6% below where we are right now. So this is the all-time high at the 37,000 mark. And I think we're in a great position to hit that. And you've got the same thing going on with the SPY. All-time high around 480 for the SPY. We're only 6% away from that all-time high. Q, same thing, about 6% from its all-time high at 408. The IWM is the only one that's the laggard, and it's about 21%, I believe, below what the all-time high is for then. So it's got a lot of room to run to catch up, and that doesn't mean that the Dow Jones and the SPY and the Qs won't, continue to go up, but, all these things, expectation, at least from David Hunter's standpoint, is that these things will run up together. He got a lot of good news this week with regards to, the drop in the rates, which he expected. He's been talking about it. The drop in the dollar, he expected. I don't know whether he thought it would come out dramatically, but like he says, he doesn't look at the day-to-day very well. Or as part of his forecast, he's probably looking more at something like these monthly data and looking at it and saying, things look pretty good, from there's the Dow Jones, So, we'll see what happens with regards. First step, let's get back to these all-time highs. The melt up is his expectation. Obviously, after that, we're going from 37,000 roughly to 48,000, which is huge. I mean, that if it does happen, and it is the end of a cycle, as he says, then this is going to be very significant. And how much can you stomach knowing or believing, as David Hunter is that the collapse comes right after that, and he says that it will happen over a period of 12 to 18 months. So I've been skeptical off and on about what his forecast is, but it appears to be kind of forming together. We've got the head and shoulders here with the Dow Jones. Don't know that I see necessarily any patterns here with the SPY or any of those, other than it's just been on a rampage up. And there's nothing. These are weekly data here. Not very many yellow candles, which are the down days, and the blue are the ups. So those are the expectations there. One of the things also to fit into his bust scenario is that the trueflation rate. And I started looking at these data. It's down to 2.11%, which is the lowest it's been now. So it's almost to where the Fed is saying. And the timing may be just about right, according to David Hunter's forecast, is that this thing, starts to go negative, at least in the trueflation piece. But right now everybody views it as disinflation and not deflation. His expectation is that we'll get deflation, as I've talked about in previous episodes. The primary expenses have been working their way down, which housing, which represents about 23.2% of it, the importance to their trueflation number. Transportation is another one, 19.83%. Obviously, food and beverage, which is 15.3%. Have been slowly working their way down on the scale here. And so we're at the lowest now. And again, it probably will take let's just take a look here. We're at 2.11 now. When we're at 4. I mean, not that this is to scale or anything, but when we were at roughly a little over 4% last time, take 2%, take us, that was back in April. So we got May, June, July, basically April, May, June, and then part of July or half of July. It's 3 months from now, August, September, October, which is about the timing. We start to see the melt up happen, and then this thing go negative, and then the worry may become deflation towards the end of the year, potentially into next year. It's fitting. The best thing I can say about the data that I'm seeing right now, and just kind of end this episode, is that it's all coming together for him. His forecast, David Hunter's forecast of all the things that we talk about, and he's taken a lot of grief for it. I've been fascinated by the whole thing and trying to understand how he's come up with the information that he has. He believes that the Fed is already well over tightened, and that's the reason we're going to get the deflation. They've made a huge policy error. We're going to go up another 0.25%. I don't know if that makes things happen faster as far as getting the 2%. Maybe some voices of reason will allow it to go by, but right now we're looking at an increase of 0.25% on the Fed funds rate, and that will put more pressure, obviously, on interest rates. I think it's already written in. I can't see, with everything I'm seeing right now happening in front of me, that these numbers would the Fed would have to look at it and say, okay, we're starting to, especially if, say in August we get a CPI of 2.5% or something like that. They've got to be starting to think about, how do we pause at a minimum. So anyway, that gives you a view of what's happening. And if you want to find David Hunter's forecast, you can find him on Twitter at David H. Contrarian. I'll put the final tab here. I guess it's going to be on this side, so that you can watch my video on David Hunter's forecast. At that time, I probably need to do an update on that with some of the new numbers that he has. But it's it's been something to watch, and certainly has plays in the back of my mind. I pay more attention to price action on swing trades, as opposed to I also do some position trading, but he's got me in some things that I might not normally be in, thinking, especially as this comes together a little bit more, that hey, this thing could actually happen. Anyway, I hope this helps you in some way, and whatever your mindset is about this stuff. And I've talked about the importance of that everybody needs to educate themselves on not only the financial tools that are available, what's going on in the economy, because if we get an 80% collapse after we get this melt up, this could happen relatively quickly too. Nobody knows the time periods, but taking it step one step at a time, get to all-time highs, start the melt up. If that's going to happen, I'd be absolutely amazed if that happens. But that starts the end of the cycle, and then the collapse basically in at the end of this year into the maybe first quarter of next year, starting around that time period, and then lasting, I believe David said, 12 to 18 months. Be fascinating to watch. I'm really curious to see how this all plays out. Anyway, that's what I'm going to cover this week, and remember, there is always a better way.